So why are asset classes so important?
Because they determine your risk.
So asset classes, number one, asset classes determine your risk level. So by depending on what you invest in. Number two, they determine your diversification. Yep. So remember, principles understand risk. Be diversified.
They also determine what your return's going to be.
More, and then
right?
What research has found is, if you can see the footnote in that document, that most of the returns comes from being in the right asset class, not picking individual stocks. So if we just pick a good asset allocation and we hold it for long term, I think generally we will be pleased with the results. So are there asset classes that you should invest in and asset classes that you shouldn't? Each of you are going to have to make that decision. We give you some recommendations. So we recommend asset classes which are liquid, meaning you can buy and sell, less risky, and with a favorable risk-return trade-off. You saw that slope of that graph, it was upward sloping. So generally, if you stick with it and you're a diversified portfolio, you'll get the returns. So we like things like bond funds, stock funds, international real estate trusts, things like this. Are there things that we don't recommend? Because ideally, we don't recommend things that are illiquid, that are risky, and without a favorable risk-return trade-off. We don't recommend things like precious metals, gold, foreign exchange options and futures. We joke that options and futures are a way to make a small fortune. Of course, you have to start with a big fortune first. We don't recommend things that their value is solely based on what someone else is willing to pay. That's why we don't like collectibles. We don't like crypto. I don't mind you having 3% of your portfolio, a tiny percent in crypto. I don't mind you have a little bit more in real estate or things like this. But the principle is to be diversified, invest low cost. Again, everything we do here, we apply the principles. How about debt? What do you think? Is it a good idea to use debt to invest? Again, we shared that story of that person who borrowed on her credit card at 24% to invest in the market when she was probably making 6-8% if she was lucky. So again, try to be wise in what you do. There's two other ways you can use debt to invest. One is called buying on margin. So do brokers want to encourage you to invest? Yeah, because every time you make a trade, they make money. So they'll lend you money. Let's say you have $100, they'll lend you another $100, and you can buy on margin. The downside is what happens if it goes down? So you can lose significantly more.
There's
also a thing called selling shares, selling short. So what you're doing is you're borrowing someone's shares, you sell them with the hope that the shares will go down, and then you'll buy those shares back and then replace the ones with lower price shares. What's the risk? What if the shares go up? So you can lose a significant amount. So when we worked at Montgomery, we would lend shares. We would make probably $2 to $3 million a year just lending shares to different brokers. And luckily that money all went back into the fund. It didn't go to us. But realize we strongly recommend, and our leaders have said, don't use debt to invest. Benchmarks have been around for 50, some of them even 100 years. You've heard of Dow Jones. And so what they are, it's a criteria against which performance is based. And generally, for example, the S&P 500 index, it's the 500 largest companies, and it's the combined performance of those. So what they are is they're indexes of investment instruments against which a portfolio performance is evaluated. So that 16%, even though it seems really good for a year, if you were in the S&P, you underperformed. If you were in bonds, you outperformed. And remember, the principle was measure performance against benchmarks. So what do we recommend? Anything with a star after it's a recommended benchmark. So for most people in my industry, which is in the investment industry, S&P 500 is your large cap index. Mid cap, Russell, small cap, the Russell 2000. You can choose different benchmarks. And if you choose the benchmark, you actually choose your performance too. And so real estate benchmarks, global benchmarks, international emerging markets. There's a lot of different ones out there. But again, the principle is the same. Measure performance versus benchmarks. That's how you tell how you're doing. So remind me again, why is it so important to understand asset class benchmarks? You can't know how you're doing until you compare it. And once you understand what the benchmark's done, you can understand how you've done. I just got on Monday we showed you a chart about SPIVA. S&P, they compare what percent of funds, actively managed funds, underperform their benchmarks. We just got the information for 2024. Of the large cap funds, 65% of the funds underperformed their benchmarks. But it was interesting, small cap funds, only 30% underperformed their benchmarks. So we just included that on the chart from Monday. Okay, questions on asset classes and benchmarks. Does that make sense? Again, the final thing on asset classes, realize research has shown that most of the return comes from being in the right asset class. Not picking the stocks, not picking the bonds. And the nice thing about for us too is we don't have a lot of time to pick stocks. But you know what we can do is we can pick asset classes. And as we buy those asset classes, we invest in those asset classes. Well, we've talked about index funds. We can beat most of the actively managed funds. And we'll show you how to do that too. Okay, let's talk about investment vehicles. I have a friend who says, well, how did your Roth IRA do last year? And I said, my Roth IRA is not an asset. My Roth IRA is an investment vehicle. It's an investment account. So what an investment vehicle, it's a tax law defined framework that gives you specific tax advantages. It can be either for retirement or it could also be for education. Sister Sudwick's like to say that's our shopping cart that we put. Sister Sudwick's and I have a Roth 401k, 401k, IRA, Roth IRA, contributor IRA, and SEP IRA. Almost all of those have nearly the same.
So they're all shopping carts.
They're all shopping carts. Most of them, for us, they have nearly the same vehicle. It's an S&P 500 index fund, either from Vanguard or Schwab. But so realize that's what it is. So an investment vehicle is a shopping cart, and a financial asset is what you put in that shopping cart.
So it's like the groceries.
So
They go in
shopping
the
carts
cart.
and groceries. So there's really three different types of accounts, and we kind of group into three areas. Number one is tax now accounts. Those are accounts that you have to pay taxes on now. If you have a mutual fund and you get a dividend or a distribution, you have to pay taxes on that every year. Then we've got what we call tax deferred accounts, like a 401k or an IRA. So you get a benefit now that you don't have to pay taxes on it now. But when you take it out at retirement, you have to pay taxes on it. So here you put it in, and it grows tax-free until you take it out at retirement. And then you have to pay taxes on principal and earnings at retirement. And then what Sister Sudwick's and I really like is these tax-eliminated accounts. These are Roth accounts. So I pay taxes on it now when I put it into the vehicle, but when I take it out at retirement, I don't have to pay any taxes on it at all.
So you don't pay on the principal or the money that you earned. You don't pay any more taxes.
Our goal was when we retired, we wanted to have roughly a third in taxable accounts, a third in tax deferred accounts, and a third in tax eliminated accounts.
So by doing that, you're picking the taxes you actually pay.
Yeah. So what we can do is, in retirement, what do we want our tax rate to be? So we pull out of tax deferred accounts until we get the tax rate we want to pay. Anything beyond that, we take out of our tax eliminated accounts because we don't have to pay taxes on it. And then what do we do with the tax now accounts? That's what we use to use donations in kind to pay our tithes and other offerings, and so we can actually rebalance our portfolio there too. So again, we kind of wish that we would have had more in Roth retirement accounts, but we're still
We do the best we can.
Now, tax eliminated. Notice a 401k. A Roth 401k is tax eliminated. You don't have to pay. When you take it out at retirement, it's totally tax free. So, how do you select investment vehicles, there's a trick. I shouldn't say a trick. There's something you do. Again, what do we do? What's our first priority with these investment vehicles? It's always free money. So what do we want? Money that's available from your company. If you're trying to decide, the first thing to do is, do you have a company match? Always get the company match. So again, those matches are, your company determines that match, but those are really, really good things. So also, if you put money into 529 plans, so we're helping our grandkids save for their education. So up to 5% you can deduct 5% of your contribution to the 529 plan up to a certain limits off your Utah state taxes. So.
Or any other state too, right? The other
it
states
varies
have it?
state to state.
Oh, okay.
Depends on your 529 plan.
Oh, okay.
But
Hawaii
again,
doesn't do
your
that.
priority should always be free money. Second, it's tax advantage money. You get to decide whether it's tax deferred or tax eliminated. Sister Studwicks and I like tax eliminated. And the reason being is if I put money in a tax deferred account, let's say we put $10,000 in, when I take it out, I don't just get the $10,000. I have to take out my taxes too, so it may only be $8,500. But if I put it in a Roth, put $10,000 now and just say nothing happens, when I take it out, it's worth that entire $10,000.
Plus whatever you made on it.
Yeah, plus whatever you made on it. And then the last one is tax efficient and wise investments. Remember we talked to you about how do you calculate after-tax returns. So know the impact of taxes. I can defer my taxes until I sell something. But once I sell it, I have to pay taxes on what's called the capital gains. I paid 10, it's worth 20.
You pay taxes on the 10.
The capital gains. But notice that the government is trying to encourage you to invest longer term. So your tax rate, they give you a preferential tax rate on long-term capital gains that you don't have on your short term.
And long term is more than a year.
Yeah, long term is more than a year. So if long-term taxes are taxed at a long-term capital gains are taxed at a lower rate than short-term. So if you trade short-term, you're going to pay the highest taxes. Turnover is a proxy for taxes. Again, the principle is invest low cost and tax efficiently. So you want to keep your turnover low, taxable distributions. And then the last one, well, you can replace interest income with stock dividends. The government would like to encourage you to invest longer term. So if you get stock dividends, it's taxed at a lower tax rate than bond interest and savings interest. And then you can also invest tax-free. So again, first priority is free money. Second priority is tax advantage money. And third priority is tax efficient and wise investments. When you do the skills development problem, you'll actually see where one person had a goal of saving X amount of dollars, and she saved substantially more because she understood understood the investment vehicle. So make sure you do that. And then investment objectives. We're going to be putting this investment plan together, and you need to understand what your objectives are. Generally, there's 3 categories. Safety. You want to make sure you preserve your capital, the value of the assets. Income, mainly income generation. You want to have more income and money coming in. And the last one is growth, mainly for capital appreciation and growth of assets. So for most of you, because you're long-term investors, it's going to be many times until you retire. You'll have some safety with your emergency fund, but most of it's probably going to be growth. You might not need income until later when you retire. We've said we don't like you picking individual assets, individual stocks and bonds, mainly because it violates most of the principles we talk about. You buy an individual stock, you violate.
You're not diversified.
You're not diversified. Again, there's some of the highest, it's some of the most expensive ways to invest. So again, we try to do that. So let's talk about what makes a good mutual fund. Remember, we've already talked about what are the principles. So the following help with one, good diversification. What was the principle? Be diversified. Again, that's your key defense against risk. Low cost, principle, invest low cost and tax efficiently. So how do you find low cost on the mutual funds? Tax efficiency, again, low cost and tax efficiency. And turnover is a proxy for tax efficiency, at least for equities. Because every time I was a mutual fund manager and every time I sold a share, I created a taxable event for the 30,000 people that were invested in our mutual fund. So low uninvested cash. You don't want to pay a mutual fund manager to manage cash. You manage that with your emergency fund. So you want to make sure your mutual funds have
Everything
97 to
invested.
yeah.
It's all invested.
And then no manager style drift. You hire a mutual fund to follow a specific asset class. You don't want him to be changing his style right in the middle. And then the last one, good performance. Smaller positive versus the benchmark. Let's go right to the good diversification in shares, low cost.
So we need you guys to go through this yourselves.
Notice in this fund here, they charge 0.02%. Large cap is 0.8. So these guys charge 1/40th of what most of the large cap funds do. Tax efficiency, again, 0.44 versus the category, which is low. Turnover, they turn over the portfolio 3% a year. They've got 0.43% cash in their portfolio. Notice that there's no style drift there. The last one that I like here is, this is just an index fund. This is their percentile rank. 2014, they were top 19% of all 1,300 funds. This is an index fund. It's a no-brainer here. And look at top 21%, top 29, 29, 26, 24, 37, 24, 51, 25. And I can bring you the updated ones on this. But again, this is an index fund, and what have they done? They've outperformed. They're in the top quartile, top 25% of all large cap funds.
So continue with your investment plan.
Choose.
Do they need to do this by when? Friday?
Yeah, we'll work on Friday. We're going to do the risk tolerance.
But what about these? It
Yeah,
says
choose your benchmarks.
It says to choose them.
Yeah, and really what you've got there, we've given you the recommended ones. If you're a U.S. person, you'll have yours. If you're from someplace else, your asset classes will be different depending on what you have available there. But again, it's the principles that are important.
There are no get-rich-quick schemes that work. These are all contrary to God's plans.
Yeah.
So if it says it's going to get rich quick, don't run
Too good
away.
to be true,
Turn
it's
around
probably-
and walk the other way.
Okay, thanks everyone.